Welcome to The Explainer. We're all about making sense of the complicated stuff. And today, we're digging into the latest quarterly report from energy giant EOG Resources. And boy, does it present a real head-scratcher.
So, here's the thing. This report throws a real curveball, something that kind of feels like it breaks the basic rules of business, right? You've got EOG, and on one hand, their profits are down, but at the exact same time, they're dropping billions of dollars on a massive bet for their future. So what gives? How can both of those things be true?
Okay, first things first, let's talk about the profit situation. EOG's net income, well, it took a hit. We're talking a drop of over $200 million compared to this time last year. It went from almost $1.7 billion down to just under $1.5 billion. And look, for a company this size, that is not just a rounding error, that's a serious dip.
But then you flip the coin, and this is the wild part. While that profit dip was happening, the company went out and made this absolutely enormous investment. We're talking almost $4.5 billion in cash on one single deal. This is way beyond a simple shopping trip. This is a game-changing strategic move.
Okay, so how do we make sense of this? Well, you know what they say. Follow the money. So that's what we're going to do. Let's pull up their financial scorecard and really dig into where the cash is coming from. And, maybe even more importantly, where it's all going.
You know, when we throw around the word profit, the number that really tells the story is net income. Think of it as the ultimate bottom line. After all the revenue comes in and every single cost goes out, we're talking everything from paying employees to taxes. What's left in the pot? That's net income. It's the real measure of how well they did.
All right, this table lays it all out pretty clearly. Take a look at the total revenue line. It's pretty much the same as last year, almost flat. But now cast your eyes down to the expenses. See that? They've jumped up by over $100 million. And that right there, that's the culprit. That increase in costs, probably for stuff like drilling and just running the business, is what's putting the squeeze on their net income.
Okay, but the revenue story itself is actually pretty wild. You'd think with profits down, revenue must have tanked, right? Well, not exactly. Check this out. Their biggest cash cow, crude oil, actually dropped by 7%. But look at natural gas. It just exploded, a 90% surge. That incredible jump pretty much single-handedly saved their total revenue number from taking a nosedive. It's a huge shift in where their money's coming from.
So, part one of the puzzle is solved. Profits are down because costs are up. Simple enough. But that still doesn't tell us where those billions of dollars in cash went. And that, my friends, brings us to the main event. EOG's massive, multi-billion-dollar bet on the future. This is the move that's going to shape their strategy for a long, long time.
So on August 1st, EOG went shopping and bought a company called Encino. And this wasn't just any company. This deal handed them a giant piece of the Utica play, which is basically a massive treasure trove of oil and gas deep underground in the eastern U.S. Just like that, overnight, EOG's map got a whole lot bigger, packed with wells that are already pumping and tons of land for future projects.
And really, this is just a brilliant picture of their long-term game plan. It's like a classic growth playbook, you know? Step 1, find an area with huge potential. Step 2, use your war chest of cash to buy up a big chunk of it. And Step 3, get to work, integrating everything and turning those assets into moneymakers for years and years. Textbook.
All right, so they're spending all this money on the future. But what about right now? What are they doing for the people who own their stock today? This is always the big balancing act for a company, right? You got to invest in tomorrow without forgetting to keep your current investors happy.
Well, one huge thing they're doing is buying back their own stock. And we're not talking small amounts. They've spent $1.8 billion on this just this year. The idea is simple. By taking some of their own shares off the market, the ones that are left become a little more scarce and hopefully a little more valuable for the people who own them.
And that's not all. They're also handing cash directly back to shareholders through dividends. But here's the really remarkable part. They didn't just keep the dividends steady. They actually gave it a raise, right in the middle of the year. Think about that. While they're planning this monster acquisition, they're confident enough to also give their investors a pay bump. That sends a really strong message.
So yeah, the bottom line here is that by bumping that dividend up to over $1 a share, EOG is basically shouting its confidence from the rooftops. It's their way of telling the market, hey, even with all this big spending, we haven't forgotten about you. Returning cash to our stockholders is still a huge priority.
Okay, so that brings us to the big question. What's next? I mean, making a multi-billion-dollar bet and promising shareholder returns is one thing, but doing it in the energy market, that's a whole other ball game.
You're dealing with constant, unpredictable change.
So how do they deal with all that uncertainty? Well, one of their most important tools is something called hedging. The easiest way to think about it is like locking in a price. They make deals today to sell their oil and gas in the future at a set price. That way, if the market suddenly crashes, they're protected. It gives them a safety net and makes their income a lot more predictable.
And to their credit, the report doesn't pull any punches about the challenges they're facing. They lay it all out there. You've got the obvious stuff like wild swings in energy prices. But then there's the huge one, making sure that multi-billion-dollar bet on Encino actually pays off. And then you pile on potential government regulation, fierce competition, even the threat of cyber attacks. It's a lot to juggle.
You know, there's a quote in the report that I think just nails their entire mission. It says, they're focused on high returns and low costs, but also strong environmental performance and playing a big role in the future of energy. And that's really it in a nutshell, isn't it? It's this constant balancing act. Be profitable, be efficient, but also be responsible. That's the mindset behind every big move we've talked about today.
And that brings us right back to where we started, to that initial puzzle. It's clear now, right? EOG is playing the long game. They're willing to take a hit on profits today because they're betting it'll lead to a much, much bigger win tomorrow. Will that massive bet pay off? Will they prove that sometimes you really do have to spend big to win big? Well, only time will tell. And that wraps up our deep dive into one heck of an eventful quarter for EOG.